The cryptocurrencies are digital currencies that are autonomous and do not rely on the central banks to record the transaction or its mining. Blockchain technology is used for recording the transactions of cryptocurrency. This prohibits the use of the same unit twice, and the data can be shared globally. As you all know, the most famous cryptocurrencies are Bitcoin and Ethereum. As all investments, many of you purchase and trade these types of cryptocurrencies. This implies that HMRC considers your gains from the cryptocurrency to be assets, and also you must pay the tax on these profit gains. But as this sector is new, regulations governing cryptocurrency taxation have been fast changing. Whenever you sell or purchase your cryptocurrency as a personal investment, then you will have to pay the capital gain tax on the profit from your cryptocurrency. The tax tips and tricks covered today in this video will be very realistic. There are many expert videos online that say they avoid crypto tax by becoming a tax exile and moving abroad and living and working there for a year, so just you can avoid the 10 or 20% capital gain tax on your cryptocurrency profits, but this is not technically possible for any person to do. Capital gains tax is a tax on the profit that you make when you sell or dispose of an asset, and you are only liable to pay the tax once you have disposed of the asset, and there are some ways in which you dispose of an asset. First is selling cryptocurrency for money. Second is exchanging crypto for another crypto, using the cryptocurrency to buy items, giving away cryptocurrency to any other person. Under any of those scenarios is the point in which you will be liable to pay tax on any of the profits that you made from that assets in thee. To simplify, the profit is that the amount you spend to buy the cryptocurrency, and the amount you sold it will provide the amount in profit. The capital gains tax is leveled on the gains that exceed the tax-free allowance. It is also critical to understand HMRC. HMRC claims that it will make the capital gains tax easy to do, but it is still a complicated subject. When you calculate your profit, you must group every sort of token like you would do for your other investment profits. HMRC revised its guidelines on the Bitcoin taxes of the UK in August 2021. While there were no major changes, as many cryptocurrency investors saw this as an indicator of the tax authorities' increasing interest in the financial business that is growing very rapidly. You must also know that the important thing to remember about the tax is that it's a never-changing thing, and different people have different ideas on the best approach to it. If careful steps are not taken, this might create problems, so the discussed ideas can be used in practice, but this does not include the extensive list of all the ways that help to reduce the tax bill, and it's just a foundation and a starting point to reduce the capital gains tax bill. For example, if you have earned £5,000 by crypto mining, then the payable tax on that amount is 20% tax. But if you earned £100,000 every year from working and then earned £5,000 from cryptocurrency, then that £5,000 will be subject to a 40% tax due to the high bracket of tax. CGT does not apply on different assets, including your house and other personal things that are worth not more than £6,000, but assets that create a capital gain, like shares, collective investment, and also second homes, are normally subject to CGT. Every person in the UK has their personal safety allowance that runs every year from 6th April to 5 April that is adequate for many cryptocurrency investors to avoid their CGT obligation. Any profit gains more than the allowed are subject to CGT event at 10 or 20%, while depending on your total taxable income that you gained in that year. Many of you may never want to pay the tax over cryptocurrency gains, so there are a variety of methods in which the CGT is minimized or also entirely eliminated. You can consider the 6 factors to calculate the city obligation on your Bitcoin investment. 1. Utilize the CGT allowance. Every person in the UK gets an annual CGT allowance that represents them to generate tax-free profits on their assets of about £12,300. Because this allowance is not allowed to carry into the next year, if it is not used then, the best way is to use it every year and award the inquiry a substantial CGT charge for the next year. While you must also consider that people that are paid in the cryptocurrencies must also be aware that Mercy would look into their accounts for their trading in cryptocurrency payments. 2. Give your assets to your spouse or the civil partner. This is also an easy way to get the crypto CGT free. Transfers between spouses are now CGT free. Its meaning is that assets are transferable between husband and wife or the civil partners to take advantage of both year CGT allowances. The CGT allowance has virtually doubled for married couples and for civil partners. This transfer must be an unconditional and real gift, so couples or civil partners can transfer their cryptocurrency to the other for exemption. 3. Use the bed and breakfast technique. This technique was used back in the 80s and 90s, but then it was changed by the lawmakers in 1998. According to this technique, you could use some of your CGT limit by selling the assets on which you made a profit and then purchase back these assets within the next 30 days. But this is no longer feasible to sell the cryptocurrency and then buy it again. While the spouse or civil partners are allowed to instantly buy their shares that were sold by their partner over the spouse, as it allows the gain to be released CGT free and it helps the family to keep their assets. 4. Make a pension contribution. You can lower the capital gain tax from 10 to 20% by making a pension contribution, where any person has their net earnings according to your profit asset from the cryptocurrency. The pension amount contribution increases the maximum limit of any person's income tax band with the amount they contributed. For example, if you made a £10,000 gross pension contribution, then the threshold during which the higher tax rate increases from £46,000 to £56,000. If the capital gain is recognized when it is combined with other taxable income in the year it falls in the extended personal allowance, then the CGT obligations reduces from 20% to 10%. 5. Take advantage from your losses. If your overall gain in the next year exceeded the yearly allowance, then it is beneficial to sell some of your assets at a loss. The gain and the losses achieved in the same year must be balanced with one another, while lowering the amount of gain liable to tax. Report the losses to HMRC within 4 years to the end of the tax year in which they occurred. While calculating your CGT payment, you can subtract certain expenditures associated with purchasing and selling the cryptocurrency from your gains. For example, you can transfer costs, exchange fees, utility payments, and some other professional fees that may help to purchase and sell your cryptocurrency. 6. Consider an investment in enterprise investment scheme. The gains of investment in the enterprise investment scheme are exempt from the CGT if they are held for the duration of more than 3 years. If the shares are sold at a loss, then the amount of the loss minus the income tax relief received can also be put for the income of the year in which the shares were sold, or if there is any other income for the preceding year instead of the capital gains. When any capital gain is invested in the shares of an enterprise investment scheme qualified firm, then the payment of tax on this gain can be postponed. This gain can also result from the sale of the cryptocurrency, but that investment must also be done within 1 year or 3 years after the gain occurs. Also, there's no such minimum holding term for the shares. The delayed capital gain is also charged when the shares are sold or disposed of, and also if they are deemed under the EIS law. The EIS plans are more risky than the ordinary stocks and shares, so you have to be very careful while taking this step to exempt from your cryptocurrency by investing in the EIS. Please keep in mind that the content of this video does not constitute financial advice and is provided for general information purposes only. It is strongly recommended that you seek professional financial advice before making any decision. For that, feel free to contact us by phone, email, or simply visit our website. And don't forget to subscribe to our YouTube channel so that you get notified every time we upload a new video. Till next time.